Hello world, this is H.L. Quist and I am the Mythbuster. Got a very important message for you today, the day after Memorial Day. I think it will be memorable. A real estate anomaly. What in the world is anomaly? Well, I'm going to answer that question for you in a minute. You know, conventional wisdom says that the residential real estate market won't recover for years, 3 and 4 years, some analysts say. Well, the contrarian in me says that it is already turned. I think this will be ample evidence to at least state my case, and you can figure it out on your own. Conventional wisdom says that, there's no in-migration. People are not moving, their situation with their jobs, they can't sell their houses and so forth. And here in Phoenix, we had tremendous recovery from the bus cycle in 1980, 81, 82, and 90, 92, and 2000, 2000. You ever notice that every 10 years we've had a bust? And, Phoenix market usually is the first that goes into the tank and is the first to recover. But this is changing now. The migration and the in-migration is changing. Now, they also say that the experts say that there's high unemployment. You can't have a healthy real estate market with high unemployment. And it won't recover until it returns to normal. What is normal? There's a new normal. 7.5%, 8.5% is the new normal. And the economy is going to boom regardless. And it's not doesn't have to go back to 4 or 5, 6%. Okay, number 3 is that the experts say there's no lenders other than FHA. The companies aren't, or the institutions aren't making loans, and there's no one there to buy the loans, and Fannie Mae, Freddie Mac are being phased out, what have you. That's going to change, as I'm going to give you some evidence here in just a second. The other thing is that they say the people can't qualify. So if you find a lender, they don't have enough for the down payment, or they can't qualify, and that whole routine. And that, I think, is going to change. Particularly the underwriting is going to change. But the biggie is shadow inventory. Experts say that here in the Valley of the Sun, that there's 100,000 homes that they haven't received a notice of foreclosure, that are not in the foreclosure process, and all this inventory is going to come onto the market at some point in time and just destroy the prices. That if we see an uptick, it will destroy these prices. Well, I see an anomaly. What in the world is an anomaly? Well, it's kind of a mining term, when you're searching for the mother lode, or you're searching for gold, silver, copper, or any of the metals, and you happen to discover a source that you didn't expect to be there. They call it an anomaly. Well, I see the real estate market as it's rebounding and people don't see it. It is an anomaly, and I'll carry this metaphor on further. And the anomaly is simply this, is that the home buyer is not the driver of this market. The investor is. Now, you already know that, but let's talk about it, and let's quantify it and qualify it. And I want to tell you about 2 years ago, using contrast 2 years ago as opposed to today. And you'll get a picture of what I'm talking about. 2 years ago at the auctions here in Phoenix, and I'm sure it's the same around the country, is that you'd have a couple people at the auctions. Minimum bid would come out, and maybe you'd buy the house at $1 over, or $10 over, or even $1,000 over the minimum bid. Today, there's just a mass of people at these auctions, and everybody's equipped with all of their cell phones and all their digital devices, and they're in communication with their investors. One home here that sold about 10 days ago at an auction in Phoenix, the minimum bid was $50,000. And it sold for $90,000 because the buyers are so aggressive, and there's so many of them. Number 2 is that these investors wanted to buy, and 2 years ago they could buy homes at 50% of replacement, or 50% of par being what caused for replacement. Well, now you can't buy those anymore. You're paying par. In other words, the investor today is almost on an equal footing with the new home builder. His replacement cost is equal to his building cost. So that's dramatically changed the market. 3, a couple of years ago, friends of mine were buying homes at auction and fixing them up and renting them, and they're returning maybe 6% to their investors. Rents were flat, and today the rentals are the hottest part of the market. It doesn't make any difference if you're in West Phoenix or you're in upscale Scottsdale or whatever, is that there is a tremendous demand for rentals. And there's another aspect of this is that multifamily, they've reached 90% occupancies here in the valley. Rents have gone up 15 or 20%. The picture has changed dramatically. Now, what this does is that it attracts investors. Investors have come from all over the world. They come from Canada, from Europe, from Australia, China. These are large pools of capital. When you start returning 15 and 20% ROI to investors, it just attracts more capital. And that's exactly what's happening. More capital chasing fewer product. There's a lot of syndicators, a lot of these companies that buy and flip companies. There's no product to buy. It's just amazing. They're searching for product. And the other thing that's happening is that banks see this. They see the recorded sales. So they're holding back their REO and their short sales. They're waiting for a better price, of course. Well, that's just going to enhance the market. A big segment of this market, people would prefer to rent than to own, right? Susie Orman, about 4 years ago at the peak of the market, she said, your home is your best investment. Buy a home. Buy now. And, of course, it was at the top of the market. She now has done a 180-degree reversal. She told her audience, she said, I made a mistake. You should be renting. She said, in my opinion, 60% of the people going forward will be renting their home and not buying it. Sure, people are scared. They've had a bad experience. But in one particular case here in the valley that I looked at, is that people were paying $1,200 a month rent, and if they qualified for FHA, they'd be paying about $500 to own. Well, there's a big spread between rent and financing, obviously, today. But here's the big news, and here's a big part of the anomaly. Most of you probably aren't up on the fact that a bill has been submitted to Congress called the Housing and Reform Act of 2011. Now, it covers a lot of things. It's a phase-out of Fannie Mae and Freddie Mac and how they deal with $160 billion owed to Treasury, which is the U.S. taxpayers. But one thing it's going to do, out of the couple things that's important for our discussion here, is that it's going to create 5 new Fannies to replace the big fat Fannie that failed. Anyway, in all this discussion that's gone into this over the last 2 years, it was generally agreed upon by the parties that were in the discussion that the government shouldn't be guaranteeing home mortgages any longer. So lo and behold, this bill contains a feature where these little Fannies will be giving 100% full faith credit of the U.S. government. So all this was shadow boxing all this time, I guess. Anyway, this is going to change the mortgage market if it's passed. This law has not been passed yet, to my knowledge. And institutions are going to get back in the market. They're going to sell to the new Fannies and so forth. So that creates, and then we don't know what the underwriting is going to be, but politically, you can just know that this market has to change in the next 12 months or the administration doesn't have a chance at re-election. Okay. Now, the other factor is that I've reported on, I've followed for several years now, the whole discourse between the federal government and the lenders, the originators, and the subprime people, the masters of the universe on Wall Street, is reconciled to the point where the government wants $20 billion in a fine against the banks that did all of these transgressions. The banks last week offered $5 billion. So a settlement is in the wind. I don't know when it'll occur. I don't know whether it'll be 10 billion, 12 billion, but this money that's collected by the attorney generals of all the states will be dispersed to people who have been evicted for foreclosure and whatever, and all these transgressions, the robo-signing and all of these things, that's all wrapped up in it. So some money is going to be paid to homeowners. Now, what are they going to do with it? Are they going to buy a new home? Are they going to give enough for a down payment or whatever? We don't know. But it's certainly going to improve and change the market. You know, we've been talking about here investors buying, you know, the $50,000 to $100,000 to $200,000 home, but there's been a big activity in high-end residential real estate. And the example of that is Sarah Palin buying the $1.7 million home in North Scottsdale. It closed last week. It also indicated that the investor that bought that house paid $800,000 to J.P. Morgan Chase to acquire that property. Well, I've learned here today from one of my clients, who's also a home builder, said that the house wasn't finished. He had to build. So people think he made 100% turnover in a year, but actually he had to finish the house. So it wasn't $800,000 profit. But anyway, what it does is that story is going to be told over and over and over again. It changes the psychology amongst realtors and builders and the entire industry, and that will have an impact also. But the big item, I've saved the big one for the last in the anomaly, and you have to think back to the late 70s to remember this, is that we had mortgage rates rising from 7% fixed 30-year to 17% in a period of 3.5 years. Home prices were doubling and tripling. People were buying homes even though interest rates were rising. Why? What was the anomaly then? Here's the bottom line. When people lose confidence in the value of their money, and they lose value in the confidence of the government, the administration, to deal with the problems at hand, they convert their paper money, their fiat money, to hard assets. That's what happened in 78 and 79. They're buying gold, they're buying silver, they're buying houses, they're buying land, they're buying farmland. A lot of that is going on right now. There's a mania now in farmland in Iowa and other areas. So this is going to be a dominant theme, a dominant driver in driving prices much, much higher. The other factor is this. There is going to be more stimulus. Ben Bernanke says we don't need QE3. That's a bunch of baloney. They're going to need it more. The economy is slowing as we speak today. What is the Fed going to do? Who's going to buy the bonds? How are the Treasury's running a deficit of $5-6 billion a day? Where are they going to get the money? Okay. Well, they'll come up with a new plan. They'll call it something else, but they're going to have to create more stimulus. That is just going to add fuel to the fire. The inflation genie that we've talked about for years is starting to party. The party is going to get hot. It's going to get, at some point, out of control. This mania is going to create real estate prices that you never even thought would be possible. And it's all going to happen within a year or 2 years. Unfortunately, then it will be over. I've talked about the crack-up boom. That's an inflationary boom that cracks up when the fiduciary medium, which is money, the lending, stops. But right now, the lenders are going to be jumping in. This is the time to buy real estate. This is the time to invest because it's a short-term run. Put as much money away as you can because when the crack-up boom occurs, we'll have massive deflation. Okay? That is the last rodeo that we've talked about. This is the Mythbuster. I hope this information helps you make a decision, and we need to do that because now is the time. The anomaly is with us. Bye-bye.